Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-hosts, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitinn, and Managing Director of International Content, Emily Parker. Good morning. It's not a good day for Bitcoin, unfortunately, is it?
No, not at all. That was people running away from it.
If you bought Bitcoin at the beginning of the year, though, you're pretty much where you started. So checking in on Bitcoin, the CoinDesk Bitcoin price.
Any time over the past few years, you're in a good shape.
That's true. The CoinDesk Bitcoin price XBX index is currently at $29,982, falling below that psychological $30,000 barrier. And the CoinDesk Ether price ETX index is at $1758, falling well below $2,000. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So definitely this market plummeting is our top story. Markets taking over the weekend after China saying banks must block crypto transactions. China's central bank saying institutions must not provide trading, clearing, and settlement for crypto transactions. So, Lawrence, we see BTC down more than 50% from its high. How low can it go? That's the question on many people's minds.
Yeah, I mean, we're talking the next support level somewhere in the 20s. The 30 level was an interesting one because there was indication that there was support there. People selling puts, according to Omkar Godbole in his piece today. When you sell puts, you're essentially locking in what you expect to be the lowest possible price for Bitcoin. We just blew through that. The strike price on those puts was at 30,000. So those people are now starting to go in the red there.
And this will be a true test of Bitcoin's resiliency. Emily, China's crypto traders have thrived despite China's stance on crypto, but what chilling effect will these restrictions have, do you think?
You just phrased it perfectly. This is a real test of Bitcoin. So China, this is all part of the same narrative. China has been having these kind of restrictions for a long time. There is the sense that they are more serious this time around, at least about enforcement. But, Chinese traders through the years have always found ways around it. So I think we're going to have to see how this shakes out over the next few months.
Interesting. And in a case of a little foreboding or foreshadowing, the Dogecoin sponsored car crashed in Saturday's Nascar Xfinity Series race, just like Doge's price. But let's take a look at our crypto markets guest.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
All right, joining us now to discuss the crypto markets is Amber Group co-founder and CEO Michael Wu in Hong Kong. Welcome to the show, Michael. What is your critique on what is happening with the markets, how China may be giving a little fear, uncertainty, and doubt into the markets, and now we're seeing a lot of selling pressure?
Thank you, Christine. Great to be here. Thanks for having me on the CoinDesk TV. Like you said, I think we are in an interesting market period, right? But it's clearly not the first time for crypto, and it won't be the last time. It is still a very young asset class. It still has quite a bit of volatility to it. It has its cycles. We experienced a very rapid cycle of adoption, right? With institutions leading the charge, and then global adoption happening. In the latest cycle, probably starting from, around a bit earlier in 2020 last year, right? Now, we are seeing a wave of correction, but at the same time, this is not new, right? I mean, every time you see a lot of the same patterns, right? You see, market overreacted, overheated, right? People get on a bit of too much leverage than they probably should have. A bit of a external shock coming from regulation fronts, and we would get to a similar situation, right? Like probably like last time in 2018 or early 2020, right? But Bitcoin and crypto broadly come out stronger out of every cycle, and I think it will continue to be this way. And not to mention, I think the fundamental for not just crypto as an asset class, but also crypto finance as an industry is a lot stronger. The fundamentals are a lot more solid this time. So, if you are really serious and long-term about crypto, about the industry, you probably are not too concerned. You just need to manage your risk, manage your position. Probably don't take on leverages that you probably aren't comfortable with, and stick to it over the long term.
Michael, you do a lot of business in Asia, and so it's great to have you on the show right now. Can you just break down for the average viewer what exactly is going on in China? Because, as you said, it's not necessarily new, but I think it's very confusing to a lot of people. What is different this time? China recently, they have new guidelines on both mining and on institutions touching crypto. Is this basically the same exact thing as before, or is there something actually different about what they're saying?
I think you pointed out, exactly the key point there, is this time, there's quite a bit of focus on mining. I think, last time in, 2017 or 2018, right, when the Chinese regulators became quite defensive or cautious against crypto, mining wasn't at least, the center of the focus back then. But this time it's quite different. A lot of the mining, I think, almost all, at least, the major mining operations were shut down this time in mainland China.
Why do you think China is cracking down on mining now? I mean, I know some people say that it's environmental concerns. Other people say that it has absolutely nothing to do with the environment. I'm curious, what is your take? Why is China targeting mining right now?
I think, an environmental concern is, in my opinion, is definitely a real factor into this, and probably, one of the major factors, right? And, China, as well as, many major countries are, pretty serious about going more carbon neutral, right? And it is, not only, it is a good move for the world, right? Anyways, but, there's also quite a bit of political, I guess, political competition in there, and, quite a lot of, I guess, big geopolitical factors into this, right? And, to the Chinese government, right, they probably, don't like crypto mining as an industry too much anyway, right? And, in their understanding, it also, goes against this, more strategic carbon neutral initiatives they're taking. So, 1+1, you're probably getting, it's probably not good news for Chinese miners.
Michael,
although if they were really concerned about the environment, sorry, just real quick, if they're really concerned about the environment, why wouldn't they just say, okay, you have to focus on renewables rather than crack down on mining entirely?
I think, like I said, it's not, I think it's one of the factors, right? And also, crypto is not currently a very, I guess, the best way to put this is it's at least not a favored industry, right? And crypto mining, as a result, right, can be a bit sensitive to many things, to the FX control, right, to the AML, KYC fronts, because I think the regulators in China are smart enough to understand, right, by investing in mining. Even on the surface, it appears as if you are investing in machines or almost factory-like operations, right? But essentially, you are investing in a financial asset, right? And therefore, it gets tricky in a capital control country, and it gets tricky with a lot of things like how to regulate the fund flows, and yeah.
Michael, one of the big narratives since this past year, since the pandemic began, was that with the increase in monetary supply and fiscal spending, that Bitcoin would provide a hedge against all that. And so we saw Bitcoin go from around 10,000 back in October, or 13,000 back in October, all the way to 60,000, and it subsequently pulled back. Has that scared off the institutions, and are the institutions that are you aware of, are they reconsidering, at least for the time being, where they should get into Bitcoin, or should they get into Bitcoin at this moment as an inflation hedge? Has that narrative worn out?
I think, actually recent market reactions and, if anything, proves these narratives, right? Proves the logic, Bitcoin, traded, I think more than just a anti-inflation asset, but it did trade it on the back of the global easing, right? And recently, with the Fed turning quite a bit more hawkish, or at least more so in the short term than many have expected, Bitcoin as well as other deflationary assets took a hit as a result, right? I mean, it's probably not the only factor, but the correlation actually proves this narrative rather than it disproves it. At the same time, on the second part of your question about institutional stance towards crypto, right? From what we see, and we do service a lot of the largest institutions, both crypto native and more on the traditional side. I think we see no slowdown in institutional interest in crypto as an asset. If anything, this probably provides them a better opportunity to assess the asset class.
Well, speaking of which, Michael, your firm provides algorithmic trading as well as high frequency and over-the-counter trading for various institutional clients. You've just recently raised $100 million on a Series B round led by China Renaissance with a valuation of about $1 billion. So what are you going to do with this money?
Oh, thank you for this. This is actually a very interesting question to me. I kind of have to ask myself too, because we don't really need the capital, to be very frank. As a startup, Ember is very fortunate to be profitable quite early on. I mean, especially over the past 3 or 4 quarters, the company actually has a pretty strong cash flow. So, it's more about really, this fundraising or even our Series A fundraising back in 2019 was really about bringing, the right institutional partners that help the company grow, right? We've gone from 0 to 1. I think now we have to go from 1 to 100. And, who are the firms, who are the people who can help us do that, right? And one thing though, I mean, no one's complaining about having more capital or more money, right? So I guess, it will, in fact, help us, be a bit more aggressive, which I think we already are in terms of bringing the best talents globally and, to really market globally, to expand globally, to set up the right infrastructure in terms of compliance, in terms of operations, in terms of branding, and really bring Ember's brand, bring Ember's services and products to our global customers.
You're building. All right. Thank you very much, Michael, for joining us.
Thank you. Thanks, everyone. Thanks for having me.
Right, that was Amber Group founder and CEO Michael Wu. Coming up, checking in on Asia and more markets analysis with Canadian crypto broker Voyager.
Okay, so
Time now for the daily forecast, an update on what's happening in the Asia crypto markets. Here's Angie Lau of Forecast News.
Welcome to the Daily Forecast, June 22nd, 2021. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. Coming up, new crypto hotspots emerge following China's clampdown. A Korean crypto conflict intensifies, and Sotheby's sets to accept crypto for a diamond auction. Let's get you up to speed from Asia to the world. With the crypto clampdown hitting China hard, we're beginning to see a variety of hotspots emerge for crypto mining. Destinations proving popular for Chinese miners to relocate to so far include Kazakhstan, North America, and Northern Europe. Zifei, a Kazakhstan-based mining company that offers hosting services, has been inundated with requests to visit their facilities in the country.
A lot of Chinese miners, and not only Chinese, maybe also Koreans who are hosting in China or doing mining operations in China, they are reaching us, asking to provide hosting services, asking for some large capacities, and asking to help them find electricity.
And China-based Canon Mining says that as well as supporting operations in Kazakhstan, its sales have increased more broadly around the globe.
The overseas market contributes over 80% of our first quarter sales, which mainly are coming from North America, Northern Europe, and CIS countries, especially Kazakhstan.
Lou says miners are generally looking for places with surplus electricity, as that keeps costs low. Over in neighboring South Korea, a fight is intensifying between the country's biggest cryptocurrency exchange and one of the coins it listed last year. The exchange Upbit last week delisted the Pika project's native Pika token. Now, its action came amid a bitter fight involving the coin count in the market and allegations of misappropriated money. And now the exchange is suing the Pika project. Upbit said before delisting Pika that one of the reasons for its action was a disparity between the number of coins the Pika project said it would circulate and the number it actually circulated. Now, Pika said it would mint 120 million coins, but Upbit says the real number of tokens was more like 330 million. Well, in a blog post in response to that claim, the Pika project claimed that the complaint was unreasonable. It said that Upbit had abolished its disclosure system earlier this year and that the change in circulation was instead posted on publicity platform Zangle. But here's where it gets interesting. After the delisting, the Pika project also said that Upbit had asked it for 5 million Pika coins for marketing promotion during the token's listing back in January. Pika said that less than 10% of those coins had been used for the promo. Well, Pika claims the 5 million coins may have been sold to users by Upbit as well, outside of the marketing event. Upbit has denied the allegations and says it will proceed with legal action against Pika, alleging that it spread false information. On the markets, Bitcoin was down 1.3% at a little over $32,500 as of 4 p.m. Hong Kong time. And in the top 10 for cryptocurrencies, rough day for Dogecoin. It sank about 20.5% and Polkadot fell by 11%. And finally today, crypto for diamonds. Sotheby's is set to accept crypto in payment for a record diamond auction. The auction house says it's the first time a diamond of over 100 carats will be able to be paid for in this way, and that no physical object of such a high value has been available in exchange for cryptocurrency. The gemstone is 101.38 carats, or around the size of a walnut, with a flawless clarity, and it's due to go under the hammer in Hong Kong on July 9th, not the diamond auction. Bitcoin or Ethereum will both be accepted, as will fiat if you prefer to do things, of course, the old-fashioned way. Well, swapping diamonds for crypto could be the modern girl's new best friend. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until the next time.
Our next guest leads a popular Canadian crypto brokerage. Joining us now is Voyager Digital co-founder and CEO, Steve Ehrlich in New York City. Welcome to the show, Steve. So we see Bitcoin falling below $30,000, that psychological level. How far do you see it going? You have a unique perspective in terms of seeing volumes and selling and buying pressures.
Yeah, we see it dropping maybe a little bit more, but we're also seeing a lot more money coming into the platform again, as people see this as another opportunity to buy. Again, this is a long-term asset. It's not something that our customers are actively trading in and out all day long. We see a lot of that, but we're seeing a bunch of our customers come in with more money looking for long-term gains on this asset. And we're seeing it not just on Bitcoin, but across a bunch of the other altcoins too that we have. More money coming in and more purchasing going on.
Hi, Steve. Welcome back to the show. Where are your retail customers? Where are they positioning their buy orders and sell orders? Do you have any indication as to where they're right now bunched up? I mean, we just went below 30,000. Is there anything down lower where you see a lot of buy orders, and anything up above where you see a lot of sell orders?
Yeah, well, we do have limit orders on the platform where people are stacking limit orders at all different prices, a lot below 30,000, because I think everyone believes that this will be a dip that will recover. Maybe it won't recover right away, but it will recover in the near future, looking towards into July. So we're seeing a lot of these stack up below 30,000 limit orders to buy.
Any particular price point?
No, I don't have that in front of me right now, but we're seeing, my team had told me that we're seeing a lot of limit orders just stack up at different price points, all below 30,000.
Good morning, Steve. Welcome back to the show. So it seems like the main things that are moving the market these days are Elon Musk and China, and recently it's been the latter. In your view, how big a deal is what's happening in China for the crypto markets over the long term? Is this just something that people are going to react to over the next week or so, and then it's going to blow over, or will this actually have a significant impact on the crypto market?
I think it'll have a short-term impact, but as I've said before, there's comments that come out of China that you don't know their real intentions, right? I mean, there's comments that come all the time about Bitcoin, about crypto, about other things. So you never take everything, at 100% face value. I think that it is a positioning tactic, and long-term that, we will recover this and we'll go well past our 60,000 that we saw not too long ago. It'll take a little time, but we see this as a short-term pain, but a lot of long-term gain.
So, Steve,
do you think it's really going to shake up the global mining industry? Like, do you see, mining actually moving to North America because of this?
There's a lot of that going on. I think you're seeing a lot of people explore that. We've seen the stories out of Miami about, mining coming to Miami. I think people will look for opportunities where they can get cheaper electricity and also stay green to be able to do that. So this is an opportunity for miners to look at different places and find where they can be most efficient with the ESG component of that as well.
So, Steve, same question I asked Michael earlier from Amber Group. Do you think that since we had the big run up in Bitcoin from about 13,000 back in October all the way to 60, and then now we're down a bit since then, has this scared off the institutional interest at all? Are you seeing that? Have institutions that were looking at Bitcoin as a potential inflation hedge maybe see that value plus hedge is a lot lower than current prices?
We deal a lot in the small and mid-sized businesses, not the really large ones, but the small to mid-sized businesses that are core to our customer base. And we're seeing more and more accounts trying to open every day now to try to participate, because I think they look at this as a tremendous opportunity for their treasuries, and the opportunity that, below 30,000, we did have this enormous run, but this is to be expected. I think that you're going to see a pullback, and yes, it's probably greater than we all expected. But at the same time, it is that opportunity. And these small to mid-sized businesses are putting money into Bitcoin and to the stable coins to earn interest as well. So we're seeing more and more of that come into the platform as well on the small to mid-sized business segment.
Meanwhile, Steve, Voyager Digital is sponsoring the first Nascar driver and race car paid fully in Bitcoin. We have Landon Cassill in a 19-race deal to be paid in a portfolio that includes Litecoin. But why? We are seeing actually a lot of people in the crypto industry sponsoring car races in NASCAR. Why is that? What is up with that? That's my question.
We're super excited by our partnership, and it is a partnership with Landon Cassill. Landon has been a user on the Voyager platform for a couple of years. I've met him a couple of years ago, and he's a crypto guy. He is someone who invests in crypto, believes in the long-term vision of crypto, and so we put a package of crypto together for him: Bitcoin, Litecoin, Voyager token, our native token, all in that package. And different from everybody else, I see a lot of one-car sponsorships. We went in for the entire rest of the season. Crypto is about community. You guys know this, as well as I do. Crypto is about building community. NASCAR has a deep community. Landon has a deep following in community. Voyager has a deep following in community. So bringing that all together to the crypto environment was something we were looking at for a while and felt the time was right. And really excited about the next 18 races. And Landon's such a great race car driver, very well connected, and a Voyager user. We felt this was really important for us.
All right. Well, thank you very much, Steve, for joining us and offering your insights.
Thanks for having me. Appreciate it.
That was Voyager Digital co-founder and CEO Steve Ehrlich. Coming up, Ethereum's next upgrade to make transaction fees less volatile and more predictable, and our global policy and regulation update with CoinDesk's Nick Day. Welcome back. Time to check in with CoinDesk Global Policy and Regulation Managing Editor Nick Day, who is also the editor of CoinDesk's The State of Crypto newsletter. Hello there, Nick. So we have the Financial Action Task Force, a G7 initiative to develop policies against money laundering and terrorism financing. They have been in an ongoing plenary session, and crypto is on the agenda. So what are they saying about crypto?
Yeah, so earlier this year, FATF published a draft guidance that basically created, some, I don't want to say strict, but some fairly onerous requirements around virtual asset service providers, i.e. crypto exchanges, and more specifically, decentralized finance platforms, which, raised some concern. It's a little bit harder to enforce traditional KYC and AML rules around certain DeFi platforms because, they don't really have a lot of the analogs that centralized exchanges do have. So there's some concern about that. What we're watching for this week is to see whether or not this draft guidance gets adopted or if, it gets modified in the coming days. The plenary session ends on Friday and they'll hold a press conference then. So I know there's, definitely been some concern around how exactly this could be implemented and whether or not it will be adopted as is.
Nick, you recently had some observations for your newsletter about Libra, now known as Diem. We just marked kind of an interesting anniversary. What is your take on that?
Yeah, it's to me, it's like the most significant, or one of the most significant projects the crypto space has seen, especially from a legal regulatory perspective. It kind of really kickstarted so much of what we see now around central bank digital currencies and stablecoin regulations, and even just kind of crypto awareness in general. Just the fact
what is
that,
the anniversary? Just for people who don't know, it's the 2 years since it was initiated.
Friday, I think. Yeah, it's been 2 years since Facebook first announced that this is what their vision was, and that they're going to try and create a whole ecosystem around this stablecoin.
So, Nick, getting back to FATF, what does that mean for the average crypto user? What does it mean for Joe Sixpack, who's trading on their Coinbase accounts?
So, most likely, the immediate impact will be less on Joe Sixpack and more on Coinbase itself, right? We already saw earlier this year exchanges, grapple with this concept of potentially enforcing KYC rules and counterparty data collection, so name and addresses, when it comes to sending funds to smart contracts and other DeFi protocols. The FATF guidance, I don't think, goes quite as far as the proposed FinCEN rulemaking, but it is still, it'll be an additional burden for exchanges to have to comply with, and they'll have to make sure that, when they're sending funds, if this guidance is adopted, by different countries, when they're sending funds, that they have the appropriate KYC and AML checks around these different DeFi protocols and smart contracts and, just wallets in general.
Mm-hmm. Nick, thanks for monitoring those FATF plenary sessions for us, and thank you for the update.
Thank you.
That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
The most expensive blockchain to use in the world is Ethereum, with users having to pay over $5 million a day in transaction fees compared to $1.5 million on Bitcoin. But this July, Ethereum's fee market is expected to undergo a radical change known as Ethereum Improvement Proposal, or EIP 1559. Joining us now to discuss is CoinDesk research associate Christine Kim, who has just published a full report called The Investment Implications of EIP 1559. Welcome to the show, Christine. So what are some of the key findings of your report?
Hi, Christine. Thanks for having me. Yeah, so EIP 1559, as you said, is a change to Ethereum's fee market. And I think the biggest takeaway from the report is that the main goal and the main impact of EIP 1559 is that it will make fees on Ethereum more predictable and less volatile. That's the goal. That's the expectation. Historically, transaction fees on Ethereum have been notoriously all over the place. And that's because Ethereum right now has this blind auction-like system where users make bids for block space and miners just choose which transactions to include based on the highest bids. But once EIP 1559 is activated, users are going to have to pay a minimum fee known as the base fee that is automatically set by the network, which, if it's something programmatic, if it's something that can only go up and down by a certain amount every single block, users will have some kind of a way to better budget how much their transactions are going to cost on the network.
So,
good morning, Christine. So if I understand correctly, this will make fees more predictable and less volatile, but it won't actually reduce the fees, right? That's not going to actually solve that problem. Like, what will it take to actually address that problem?
Yeah, that's a good question. That's one of the biggest myths, I think, about EIP 1559, that the kinds of efficiencies that the code change is going to introduce to the network will also have an impact on the scalability of the network, and that's not true. EIP 1559 will make fees more predictable, but as you say, it won't actually make the cost of these fees go down. What will impact Ethereum's scalability and be able to boost the network's ability to process more transactions in one go and thereby make the cost of those transactions go down. That is developers are working on different solutions for that. One of them is called sharding. And what sharding does is it splits the blockchain into multiple mini blockchains so that in parallel, these blockchains called shards can process transactions. This is supposed to boost the scalability of the Ethereum network by like over 64 times, but that code is still being actively developed. So it's not ready to go, ready for implementations like EIP 1559 is. Outside of that, there's also layer 2 technologies. So similar to how you can make faster payments on Bitcoin through the Lightning Network, there are also layer 2 networks on top of Ethereum that are working now that users are starting to go to get cheaper transactions, like Polygon. Polygon is another really popular layer 2 network.
So, Christine, what does this mean for investors? What happens ultimately when this is implemented? How would they look at it?
I think one of the things that a lot of investors are thinking about when it comes to EIP 1559 is the burn mechanism. And with EIP 1559, the burning mechanism refers to a programmatic way to take coins out of circulation after they've been issued on the Ethereum blockchain and basically offset supply increases on Ethereum without introducing a supply cap. Because for a long time, there's been this kind of a logical fallacy where people didn't consider Ether as a good store of value because Ether supply would just increase infinitely. There wasn't like a set 21 million coins hard limit. There wasn't any of that. And inflation on Ethereum is roughly 4% right now, whereas on Bitcoin it's roughly 1.8%. So for all of these reasons, I think investors, when they heard about EIP 1559, thought immediately, maybe 1559 could be the way to start to strengthen the investment case for Ether as a store of value. I think that it's a strong case, but we're not quite sure that it's going to have that impact just yet. The main reason being that the burn mechanism is dependent on demand. So if demand for block space on Ethereum is really high, then lots of coins are going to be burned, and that could offset the amount of coins being put into circulation. But if demand is low, if there's a point in Ethereum's future where not a lot of people are using the blockchain, then the burn mechanism is not as powerful or as effective. So that does introduce some kind of an economic stability to the long-term monetary policy of Ethereum over time.
Okay. Well, for folks who want to see the full report, go over to Christine's newsletter as well as CoinDesk.com. Thank you so much, Christine, for joining us.
My pleasure.
Right, that was CoinDesk research analyst Christine Kim. That's it for our First Mover. And coming up tomorrow is special guest Circle CEO Jeremy Allaire. Thank you, Emily Parker and Lawrence Lewitinn. I'm your host, Christine Lee. I'll be back live at 3 p.m. for All About Bitcoin. Coming up at noon is The Hash. You're watching CoinDesk TV.